Yes, got this screen?
Yes, ma'am.
Yes. Yes. So in last class, we did all the M1, M2, MC currencies and everything and all. Now we'll see what are the functions of banking, and we have commercial banks also, and what are the functions of the central bank. These are very important. So when you talk about banking, there are two things you need to understand here, central bank and commercial banks. When you talk about central banks, it is one of the apex body that controls, operates, regulates. That means it operates three main functions. It has a control over the financial thing, and it operates all the financial related transactions, and it frames all the rules and regulations in relating to your banking, and it directs the entire banking and monetary structure of the company. And when you talk about commercial banks, yes, commercial banks are those institutions which performs the functions of accepting checkable deposits, providing loans and making investments, which aim of earning the profits, which has the power to create money using the DDs. For example, you have Punjab National Bank and Canara Bank. So all the banks are financial institutions, but all the financial institutions are not banks. Remember this, banking structure is different, financial institutions are different. So banks should accept checkable deposits and give out loans. Next, you have functions of central bank. Yes, the first function what it has is central currency authority or bank issue. Yes, central bank has the sole authority that it has the right to issue the currency notes. Yes, it RBI is only one banking in the whole country. Okay, except 1 rupee note and coins which are issued by the Ministry of Finance. Okay, withdrawal and putting all the circulations of currency money into the depositing, accepting all these functions is performed by the RBI. And all the currency issued by RBI is monetary liability. So they are liability to things. For example, central bank is obliged to buy the currency, buy back the currencies with assets which should have all your coins, golds, foreign securities of the equal value. And what are the advantages of this function? When the main function or the advantage of this function is, so it leads the uniformity, oneness in the note circulation. So the flow of money should be uniform, first function, advantage. And it gives the central bank power to influence money supply and ensures public faith in the currency system. So public will have some kind of, what you say, faith in the currency system. And third thing is it enables the government to have supervision and control and overhaul over the central bank with the respect of issue of notes. And it helps in stabilization in internal and external value of currency. Yes, so very important. Now, the second function of central bank is to banker to the government. Yes, RBI acts as banker's bank, agent and other financial advisor to the state and the government. So it plays a very important role in this. And the second one is, as a banker, it carries all the activities that has been governed by our government. So what are the activities that has been governed by our government is, it maintains cash balances in the current account with RBI. So it has to maintain some kind of cash balances, okay, in CR account, current account with the RBI. That is mandatory. Second one, RBI accepts receipts and make payments on behalf of the government. So here government will not take a part. On behalf of government, it is the RBI who accepts receipts and make payments on behalf of the government and carries all the banking operations for the government. And the central bank also provides short-term credit to the government so that the government can meet any shortfalls in respect over disbursements. That means it provides the short-term credit to government so that the government can meet all the shortfalls. If any kind of deficits is there, all those things it can balance. So the government carries on short-term borrowings by selling ad hoc treasury bills to the central bank. So it acts as two things. It acts as agent, it acts as a financial advisor, very important functions. It acts as an agent, how? Yes, it is the responsibility of the manager to act as an agent for managing all the debts of the banking system. This means the central bank has managed all the new issues of government loans. And as a financial advisor, the central bank advises the government from time to time on economic, financial and the monetary matters. Very important functions these are. Now, when you talk about the third important aspects, that is bankers, bank, and the supervisor. Yes, as a banker, he, not he, the central bank, you can say it as an institution also. It has three very important functions here. Custodian of the cash reserves, central bank is the lender of the last resort, and clearing house function. So very three important functions are mandatory when it acts as a banker's bank. See, when you say custodian, commercial banks are required to keep certain percentage of the deposit with central bank. Very important. Every commercial these things, banking systems are required to keep some 10% of their deposit with the central bank. And while other in this way, they try to, keep some kind of cash reserves in the commercial bank. So the sole aim of these reserves to enable central bank to provide financial assistance to the commercial banks in the time of financial emergency. So when commercial bank fails to meet this financial requirement from other sources, they approach the central bank to give loans and advances, because this is the last things what they have to do. So they try to give the loans on the things. So the central bank helps them through discontinuing approved securities and the bills of exchange. So it's the last lender that is there, which can be done. And next is central banks as a supervisor. Yes, supervisor regulates and controls its activities of the commercial bank. The regulation of banks may be related to licensing, branch expansion, mergers of banks. All these are the options that has been really given to the commercial bank, because the central banks depends upon this, and they want to supervise how the banking activities have been taken place. So the control is exercised by periodic inspection of banks and returns to be filed by them. The fourth function is custodian of foreign exchange reserve. बाथरूम में हाँ दे देती. Yes, so just a moment. Yes, so the next fourth function is the central bank acts as a custodian of the country's stock of gold and reserves of the foreign exchange. So the function enables the central bank to exercise a reasonable control on foreign exchange. So as all foreign exchange transactions must be routed through RBI, it helps the bank in stabilizing the external value of currency and pursuing a coordinated policy towards the balance of payment. That means what this function says, that every central bank, okay, needs to practice this or should have this kind of exercise of having a good control over the this one, establishing a value of currencies, okay, pursuing any kind of policy that has to be made in the payment of payments. Yes, so therefore, next function is control of money supply and credit. It's very, very important. Okay, central banks have a good control and they need to have this control over the money supply. And central bank controls money supply by using various methods. They use two methods. One is qualitative and one more is quantitative. Qualitative means both the methods have been used either by counting or by knowing the value of the currency. We'll see in detail both the methods, and this is very important question from the point of view of exam. First one is when you talk about quantitative, it helps to control the volume of credit and money supply in the economy. Yes. Now, when you talk about qualitative instruments, okay, first you have here his bank rate. See, bank rate is the rate at which the bank lends money to commercial bank. Which bank? So here RBI is lending money to commercial bank. There is one bank rate at which this transaction happens. It is not for short period of time. It is for long needs. It is known as bank rate. And when there is an increase in the bank rate, the cost of borrowing also increases from the central bank. So as a result, by seeing this, the commercial bank will also increase the rate of interest at which they have to lend the money to the public. So thereby making the credit very, very costly. So this discourages the public to borrow some money from the commercial banks. So by doing this, what will happen? The circular flow of money or the credit supply becomes less. And this will lead to decrease in the bank rate if it is having the opposite effect, because banking rate will have an adverse effect. So that's the reason. Now the second one is L, legal reserve requirement. See, when you talk about legal reserve requirement, there are two accounts, CRR and SLR, very important. Okay. Cash reserve ratio. Here, there is certain percentage of net demand and time deposit that the commercial banks are legally required to keep cash reserves with RBI. So they need to keep some kind of money as in the form of reserves with the RBI. This is called as cash reserve ratio. Whenever there is an increase in this, then there is a higher percentage of the deposits, and RBI reduces the credit availability with them. So whenever there is a decrease, so then again there will be a decrease in the flow of money in the economy. So decrease in CRR will have always an opposite effect. Now statutory liquid ratios are those ratios, okay, or you can say it is that ratio liquidity where whatever the reserves, time deposit, commercial bank, it is there, immediately you can give the form of liquidity. You can convert those into an asset such as government securities and other things. So an increase in SLR will always reduce the ability to give the banks to loans. So hence they cannot follow in further, and that will really have an adverse effect on the economy. And a decrease in LSR again will have an adverse effect or the opposite effect in our economy. Now, next third function what you have is open market operations, yes, where you can buy and sell the government securities. So here, open market economy operations are those, it refers to buying and selling of the government securities or bonds by the commercial bank from one to another, or it can sell to each other or even to the public as well. So any sale of securities by the central bank will reduce the reserves with the commercial banks. When bank gives central bank a check for securities, which will reduce the bank ability to create the loan. So therefore, it will stop the reserves. Okay, it will always reduce the reserves on the other side, and also money supply also will be stopped. Next, you have, in order to expand the flow of credit in the economy, what does central banks do? Central bank purchases security. So here they will go and purchase security from the commercial bank, who RBI. And in turn, they give the banks a check drawn on itself for payment for the security. So they give the checks, and when the check clears, again, the central bank increases the reserves by payment in itself, and therefore there will be an adverse effect in the economy. When there is an increased ability to create the credit and lend more and more, and therefore there is a supply of money increases in the economy. Next is repo rate, very important. Repo rate is nothing but repurchase. Repo means repurchase. Okay. So it is the rate at which the commercial bank can borrow from the central bank just to meet the short-term requirements or any kind of emergency requirements. So an increase in the repo rate will make borrowings from the central bank very costly. As a result, bank will lend at public at a very higher lending rate. So therefore, borrowing will discourage the credit, costlier, and always there will be a decrease or lower effect on the economy. So a decrease in repo rate will always have an inverse effect. Remember, it is that interest rate at which the commercial bank can borrow from the central bank just to meet the short-term requirements. And what is this reserve repo rate? This is also important. You see, reserve repo rates are those interest rates where commercial bank, okay, get or they are benefited for the surplus funds with the central bank. They enjoy that, okay, the interest rate. So the raising of RRR gives incentives to the commercial bank. Commercial bank are benefited here to park their funds with the RBI. So they have kept their funds with the RBI. So this reduces the credit availability to the commercial bank and adversely affect the lending capacity. So it will be reserved here, but it will affect the lending capacity. And again, there will be a low or decrease in the money supply of our economy. So lower RR discourage commercial banks. So this will increase the credit availability with the commercial bank because they are at benefit here. So they are into a benefit purpose. So all these are quantitative instrument. Next, you have qualitative. So you have only one method, that is, or one, this one is money margin method. Yes, now before going to the next method, just quickly read one so that let it be revised. So it's very important. Functions of commercial banks are very important. Shall I scroll down? Kirtana, Ashu, Tanisha. Hello.
Yes, ma'am, you can scroll.
Yeah. Yes. And this quantitative instruments are very important. Okay, they might ask them as the following, or they might ask for MCQs, or based on assertion reasoning question will be there. Okay, go through. And bank rate, CRR, SLR, all these are very mandatory. Yes, please go through the SLR and open market operations. Yes, done.
Yes, ma'am. Done.
Yeah. Yes. Now next we will talk about the what? Quantitative measures. See, when you talk about qualitative measures, the first thing what you need to know here is margin requirement. See, it's the difference between the amount of loan and the market value of security offered by the borrower against the loan. So loan amount and any kind of market availability for the loan. Yes, so therefore, by changing the margin requirement, the Reserve Bank can alter the amount of loan. Whatever the amount of loan is being required, that can be altered. So therefore, to reduce the money supply in the economy, the margin requirement has to be increased. With less loan amount is given against the same value of security. If same value of security is given, that can be altered or it can be changed. So therefore, what is the difference between, so these are some of the measures of qualitative and quantitative terms. Now we'll see the difference between the central bank and commercial bank. See, central bank is RBI. So it is apex body which control, operates and regulates. But here it's an institution which performs the functions of accepting and borrowing and giving, and it is owned and managed by government. It can be owned and managed by government or any kind of private sectors. So it is both. Okay. Yes. So it operates for the public welfare without any profit motive. So it maximizes the profits. Yes, so it has sole authority of printing new currency, and here it has the role of creating the credit. They only print, they will create the credit. So it acts as a banker to the government. It has no such powers that it can act as a banker. Very important. Just read this difference between these two. So hope you got the difference between the commercial bank and central banks.
Can you scroll?
Yeah. Up or down?
I'm down.
No, that I've not done. No, I've just asked you to go through these two, okay? Yes, done. Okay, just a minute. Yes. Okay, done with till here. Now the next topic, what we are going to do is very important as per your thing also, money multiplier. Okay, what is this money multiplier? What is it? Yeah. What is money multiplier? Hmm. Hmm. Yes. See, this money multiplier is nothing but credit creation by the commercial banks. See, credit creation refers to the process of creating the credit by the commercial bank with the help of deposits and give them LRR. Okay. So now what is LRR? It is legal reserve ratio. Okay. They have two assumptions here. First, they have to keep an initial deposit of 1,000 rupees. Second thing, they should have LRR, legal reserve ratio, assumed to be as 20%. Now, what is this LRR? See, the legal reserve ratio is the fraction of deposits that the banks have to keep compulsorily in the form of cash. 20% of cash, they should keep it in the bank. Okay, with central bank. Okay, or designated liquid assets. Okay, they can keep cash or liquid assets with themselves. So these may be in the form of CLR or SLR. Now, there are two principles under it. All transactions.
Credit creation is only done by commercial banks.
Yes. Yes.
Ma'am, credit creation is it only done by commercial banks?
CLR and SLR, yes. Yes. Now, the two transactions are routed through the banks, and all the banking system is treated as single bank. So they have one assumption of this, and principles are every banking system should have one single system of banking. Now, how it works, I'll tell you now. See here, suppose the deposit in banks is 100 rupees and legal reserve ratio is 20%. That means bank should lend out 80% because 100 minus 20. So this 20 will go in the form of cash or securities. So left out is 80%, 100 minus 20. So 80% they can borrow. That is 800 rupees out of 1,000. It is 800. And it does not open an account in the name of borrower.
So therefore, if the borrower wants to withdraw the entire amount and make payment using 800, since all transactions are routed through the banks, the money comes back to the bank in the form of deposit. So how much you will get? So now credit created will be increased. So it will be 1000 plus 800. It will be 1800. Please read these 2 points again. Then I'll move to the third point, which you will understand. There into at 640. Yes, now listen to me. Now again, when a bank uses 800 to lend after keeping 20% as reserve, so 160 and lending amount will be 640 as a fresh loan to borrowers. Then what happens? Again, they're taking the 640 as fresh. So now it will become 1000 plus 800 plus 640. So it will become 2440. So this continues in each round. The deposit creation is 80% of the previous round. So these increases become smaller and smaller and continue till the initial deposit is equal to the reserve. So initial, your deposit should always be equal to your reserves. For that purpose, they have taken 80% of creation and 20% in the form of reserves. So therefore, the value of deposited created 1 by LLR. So initial deposit will be 20%. So that goes 1000. So therefore, 5 into 1000 will become 5000. Now you understand here, if deposit is 1000, loan will be given 800 and kept as 200. Yes, now understood. If you have 1000 will go for deposit, 800 will go for loan, 200 which is left out. So it should be kept as reserves. Now again, if loans, if it is given, so now when you save 100 to 800 as a deposit, in that 640 you give loan. So 160 will be kept as a reserve. Now when you give this 160 as a deposit and giving 512 out of that in loan, and balance will go as a reserve. So when you add up, you'll get 5000, 4000. So 1000 rupees will go as a reserves. Yes. So the next is components of money supply. So we'll quickly revise from here what all we did, and we will stop with this. Okay. There is few reading material also relating to banking. What we did is given here. I will send you this PDFs also. Okay. You can quickly glance now. Okay. So here components of money supply are CDD is equals to money supply. Currency is public deposit that is outside the bank. DD is nothing but a demand deposit with the bank, and that will lead to the money supply. So bank or currency, you have government one side and bankers bank. So main functions is having a good control and deposit over the banks. Control of what? Credit control measures. You have two measures. I said you quantitative and qualitative measures. In qualitative, you have only margin requirements, but here you have repo rate, bank rate, RRR, open market operations, and CLR and SLR. Very important, these two methods are.